So welcome, ladies and gentlemen. I'm sorry we were a bit late. I think we did have some difficulties with the technicalities. All this has to be live streamed, you see, to accord with the very strict Bank of England rules. So I'm hoping that this is now going to be live streamed. And in fact, the speech is already on the website, I believe. So the rest of the world has got selective access over us. You know, it's the other way around. So my name is David Marshall. It's a great honour to introduce you, Catherine Mann. You know that she's been on the Monetary Policy Committee since September 2021, and just by some strange coincidence over that period of time, there's been a huge amount of rate increases. And you come at this from a very good background you were at Citibank, with the OECD, with Brandeis, and working with the Bush administration. So a tremendous background to being part of the MPC. And I worked out, because in my youth I used to be an aficionado of the Wisden Cricketing Almanac. And in a couple of meetings, if you keep up your track record, you will beat the all-time record for the central bank person in the UK who's voted for more increases than anybody else. That record is held by Andrew Sentence. He had 56 meetings. You've only had 20. So you've got to score 18 out of 20. So you're on a bit of a roll, I would say. So we're all looking forward very much to what you have to say. Over to you for your speech, and there'll be some questions and answers afterwards. So thank you for coming with us.
Thank you very much. I was worried when you went on the cricket thing, metaphor there, because I'm thinking.
Just for effect to show that we know what we're doing.
Well, these work in this better because I have to read it, right? So I'm delighted to be back here, joined by David and the rest of the folks here from OMFIF. You've always set up a really great venue, which is just spectacular, as well as the audience. So when I moved to the UK, I had to learn a new vocabulary. Crisps, lorry, bits and bobs, and there are a lot of other ones that us Americans don't really know. But there is one UK phrase that does have global reach, and that is mind the gap. So of course I'll interpret this mind the gap through the economist lens, and that of course is the title of my remarks. So I'll start and talk about, as recently presented in the February 2024 Monetary Policy Report, which I'm sure you've all read, consumption growth in the UK has been weak, market sector output growth negative, and GDP flat over the last year. The latest data for headline inflation surprised to the downside relative to what had been expected in November. As a result, looking at the current forecast, inflation is at target by the end of the forecast horizon. From this vantage point, monetary policy is working, patience is warranted, and a hold could have been my appropriate vote. But in my assessment of the outlook, real household incomes continue to rise as inflation falls. Consumer confidence has improved. Indicators of services activity have come in strong, and forward-looking measures of output and employment paint a positive picture. The labor market is still relatively tight and is loosening only slowly. Financial conditions have eased substantially since September, when the MPC decided to hold bank rate at 5.25. In part, this is because markets now soon expect bank cuts. So this constellation, to me, points to somewhat stronger demand going forward. And against a backdrop of sluggish supply growth and possible upside shocks, I see risk of continued inflation momentum and embedded persistence. Inflation is the most pernicious of taxes, affecting all households and those at lower income most severely. So considering both backward-looking outcomes and my forward-looking assessments and risks, I determined that it was prudent to vote for another increase in bank rate. It was a finely balanced decision. In these my remarks, I'll focus on minding the gaps, And these gaps collectively point to both enduring persistence as well as upside risks to inflation. These make achieving the inflation target sustainably and within the forecast horizon elusive. These gaps come from energy prices, the evolution of goods versus services inflation, and asymmetric behavior of firm pricing. It is important to take an active stance against these gaps persisting, and especially to push back when financial conditions have eased too much already. So let me now talk about the gaps. Which are we going to get them to work? All right, where am I? Here we are. Okay, all right, what's the first gap? The first gap is the energy price gap, as shown in this chart. Inflation has come down very sharply, and the most recent data in December surprised to the downside relative to expectations in the November NPR forecast. Should we take the direction of travel and the magnitude of the surprise as the key signals of continued rapid deceleration of inflation, erosion of inflation persistence, and absence of upside risks? I would argue no, not fully on any of these. One reason for the forecast error gap is that comparing November's inflation forecast in the dotted lines to the actual data in the solid lines comes from the falls in the futures curve for energy prices. Gas and oil are in aqua and orange respectively. These futures curves are key conditioning assumptions in the MPC forecast. They both fell particularly at the front end of the curve, which accentuates the forecast miss that we just experienced in the aggregate inflation. Another reason for the rapid deceleration is arithmetic. So-called base effects account for about 1 percentage point of the deceleration of the year-on-year headline inflation in Q4 2023 alone. The calculation of annual price changes is heavily influenced by the unusually high level of energy prices 1 year ago, and thus does not present news to the trajectory for inflation going forward. We can't expect this arithmetic to flatter inflation in the medium term. So where is the computer that this is driving? I'm serious. This is not really acceptable. Can you do them? Why don't you do them, and I'll just tell you when to do them. Okay. So if we look at the next chart, this is, here we go. Under the conditioning assumptions in the latest forecast, the gap between headline and non-energy inflation rates, that's in the aqua and the orange lines, shows how important direct energy dynamics have been and are in determining the headline inflation profile. In the February forecast, headline dips to 2% in early 2024, but only briefly. It's a touch and go. Stripping out the energy contribution to CPI inflation shows a much slower deceleration. Without energy contributions, inflation, in fact, never reaches the 2% target within the next 3 years. Of course, we cannot know whether there will be further energy shocks over the next 3 years, but given the currently low energy price futures curve, this is low at least in the context of recent years, and combined with the geopolitical stresses, I think it's prudent to consider that the risk of a higher energy price is greater than that of a lower one. So my first point is, I am not convinced that the near-term deceleration in headline inflation will continue. I weigh more highly in my assessment the medium-term trajectory and particularly the distribution of potential risks to inflation going forward. So let's move to the next gap, which is the next chart. That's the cross-region comparison gap. Next chart, please. Over the past few years, UK inflation dynamics have been compared to both the US and those of the euro area, with some people suggesting that the UK is just a little bit later than its peers in returning inflation's target. A look at the data suggests to me that the little bit later might be quite a while later. In order to evaluate this point, I'm looking at 3-month on 3-month changes in the CPI. I first spoke about the importance of looking at these high-frequency changes when, in order to identify turning points in my speech in Hungary almost exactly a year ago. First, look at the gap in the UK data between headline and services inflation. This is in the left panel, after they have fallen from their respective peaks. If anything, the gap is widening, so mind the gap, especially comparing that for the US and especially for the euro area, which are the center and the right panels. In the UK, services inflation is 3+ percentage points above headline inflation, twice or even 4 times wider than the US and the euro area respectively. So why does this gap matter between headline and services inflation? It suggests further persistence in underlying drivers of services inflation, which do not appear to be as significant in the US or the euro area. These types of drivers include wage pressures, but also firms' desired profit margins. Our agents indicate that firms will try to pass on cost increases, particularly in consumer-facing services, and rebuild margins when cost pressures abate. The research using machine learning methods to evaluate services prices, which I discussed in my September speech, shows the importance of these inertial factors for persistence in services price inflation. Since services are a large part of the consumption basket, about 50%, if they persistently grow at higher than target consistent rates, returning headline inflation sustainably back to 2% will be difficult. So this leads me to my next gap and my next slide. That's the goods and services price inflation gap. So the evolution of goods and services prices is important for achieving the 2% sustainably in the medium term. While goods inflation has come down quickly along with energy and other goods prices, services inflation continues to be sticky, and you can see that in the various colors. To help understand the current divergence of goods and services price inflation dynamics, it is useful to evaluate their historical relationship over a period when inflation did average about 2%. Between 1997 and 2019, services inflation tended to run at about 3.5%, and core goods CPI inflation about 0%. Those are the dotted lines in the chart. I would call this a target consistent combination of goods and services price inflation. So what does the gap look like now? In year-on-year terms, which is in the left panel, core goods price inflation slowed from about 5.5% in the September data to about 4+ in the latest data release for December. In fact, if you look at the 3-month on 3-month annualized basis, it was close to 0. So goods price inflation was quick to rise, seems to be quick to fall back to historical average, at least at the higher frequency momentum. In contrast to this volatility in core goods inflation, services inflation was slow to rise and has been elevated at about 6% year-on-year for the past 18 months. Services price inflation has only slowed to somewhat above 4 on the higher frequency measure. So will this rapid decline in core goods price inflation combined with a very sluggish adjustment in services price inflation yield a target consistent overall inflation in the medium term? So prospects for the persistence of overall inflation depend on how this gap between goods and services inflation evolves and whether these series are returning to their historical pattern. So I'm going to turn to and dig deeper into firm surveys and CPI microdata to help me make this assessment about the return of the aggregate series to their historical relationship. So let's look at the next chart, which is evidence from firms' pricing plans. The decision maker panel, so-called DMP surveys, which of course are online so you can look at them yourself, these show their own price realizations as well as prospects for prices 1 year ahead. Mapping these surveys, which are the solid lines, to the CPI inflation that I just talked about in the dotted line, for services in blue and goods in aqua, show a pretty close relationship for services between the DMP data and the CPI services data. This is less convincing for goods, and that's because the sample weightings differ. But we're going to focus a lot on services, so I'm feeling pretty good about that. The historical DMP data prior to COVID and the energy shock show a pattern of price realizations for goods and services that are consistent with the 2% inflation target over that time period. In other words, these CPI patterns in history map into a time when services, when overall inflation was at 2%. They're not at 2%, 3.5% and 0% themselves, but they map into an environment of 2% for overall inflation. So a return to this close pattern that you see in the historical data for DMP is one possible combination of goods and services inflation going forward that would be consistent with a 2% objective. Now the DMP firms' expected prices for next year, those are the diamond markers, show that firms' own price inflation is expected to slow over the next year for both goods and services. Based on these expected prices, even if the gap narrows back to the historical patterns, so the gap is narrowing, and they're both decelerating, but they're achieving inflation rates inconsistent with a target of 2%. So continuing the theme of looking again ahead on firms' expectations, what can they tell us about firms' pricing behavior relative to their competitors? So we're going to now move to some new research, a new chart. Okay, so we have internal research that, well, it's in a Vimeo, so it's available. Research using firm-level data on firms' expectations about inflation shows a positive link between firms' prices and their own price expectations. So what they realize today, their expectations tomorrow, as well as expectations about their competitors' pricing. Now the blue bars in the chart show the positive relationship between own price realization and own price expectations. So firms are pretty good at getting the expected price that they thought they were going to get. That's similar to what we see in the DMP data. The dot is the regression coefficient and the shared area is the confidence band. Now the orange dots and bars reflect how a firm adjusts its expected prices based on what it's expecting its competitors to do. So it's both looking forward, the price of an individual firm, looking at what it thinks its competitors is going to do with its prices. So when a firm expects its competitors to raise prices faster than the firm itself intended to do, the firm typically will adjust its prices up faster to match its competitor's price. This is the orange diamond on the left-hand side. This is the environment where the firm is pricing up to match its competitors. The same is not true when the expected own price is below the expected industry price. And that is, there is no statistically discernible change in the firm's pricing behavior stemming from expected industry inflation when that is below what they intended to do. So these results suggest that price rises propagate more strongly across firms than do price decreases. Firms are more inclined to catch up with their competitor prices. They do not catch down. What does this mean or imply about aggregate inflation when we aggregate up all of the firm level behavior? This kind of asymmetric pricing behavior adds to persistence and may even yield an upward bias to inflation. So let's move on to another gap between goods and services prices, looking at consumer microdata. So this is the next slide. Very detailed data. Granular data provide important new insights into underlying drivers and dynamics that influence macroeconomic inflation. Microdata on the components of the Consumer Price Index, these are published monthly by ONS, provide detailed price data at the item level for around 700 item categories that underlie the construction of the CPI. Research by my front office team, Leonard Brandt and Natalie Burr, along with a PhD student from Brandeis University, Chris Gatto, they document, and this is in a Bank Underground post, that at the micro level, most prices do not change month on month. Those are the purple lines in this chart. For goods, about 80% of prices on average do not change each month. For services, the share of stable prices is more than 90%. So the monthly inflation dynamics in goods and services in headline CPI, the releases that we get every month and pour over, come from a very small share of price changes that do take place. As shown in the chart, the gaps between price moves and price holds have changed significantly over the last 2 years. Examining these microdata gaps gives insights onto prospects for overall inflation to return to the patterns associated with achieving the 2% target. What has happened in the microdata for goods since inflation started to slow? This is in the left panel. First, as inflation surged, the share of goods prices increasing month to month rose from 10% to 20%. That's the blue line. That share has now fallen back to 10%, in line with the historical pattern of price changes month on month. The share of price decreases has risen, but that's the orange line, but only a very little, and it currently sits at the 10%, consistent with historical experience. So the deceleration of goods price inflation that we observe in the overall sort of macro data comes from a return to normality for price increases. So far, so good in terms of getting back to the pattern consistent with the 2% overall inflation target. Now, looking at services price changes in these microdata, they behave quite differently. This is on the right-hand panel. In the past, about 5% of services prices increased each month, that's blue, whereas prices hardly ever fall. That's the orange. They're pretty much pinned there at 0. When inflation started to surge, there was a doubling to 10% in the share of services prices increasing month on month, and that persisted for 2 years. In the recent monthly data for December, about 7% of services prices increased on the month. This is welcome, and it does show a deceleration in the share of firms raising prices or product prices, but the share of price increases remains above the pre-COVID share, and so it's not back to the pattern of services prices, which along with goods price dynamics did yield in the past the 2% inflation. So I'd like to get out of the deep dive into the data and widen the lens from this microdata to examine my next gap, which is in the next slide, and this considers goods and services from the standpoint of the MPC's inflation forecast. So bank staff have produced a wide range of research providing cross-checks to our model forecast. And I've highlighted a few of those in my speech in September. Another one of this example is a Bayesian VAR model, which is designed to produce projections for major CPI components such as services and goods inflation rates, which you see here, as well as inflation expectation and wage growth. And these are designed to be consistent with the main NPR forecast, which I showed you a number of charts ago. The objective of this BVAR apparatus is to extract more disaggregated signals from the historical data and to evaluate the risks of above target inflation persisting. As a reduced form VAR, it does not impose any structure on the underlying shocks, causing changes in the variables of interest. Now the chart shows the BVAR implied forecast for services in the left and core goods in the right, conditional on the MPC's forecast produced and published in the February report. The actual data are in the blue lines, with the conditional forecast in the white with confidence shaded as shown. These are the model implied paths for services and core goods that are consistent with the MPC's forecast for headline inflation and activity. And of course that headline inflation and activity does come down to for headline inflation, does come down to 1.9 at the beginning of 2027. The BVARs suggest that in order to explain the headline forecast, services price inflation will need to experience a steep deceleration in the first half of 2024, like now, before falling more gradually over the remainder of the forecast to its sample average, which is the dotted line. And you've seen these dotted lines before. Sample averages. The corresponding profile for core goods falls rapidly over the first half of 2024 before rebounding temporarily with the base effects. This kind of matches the energy forecast, and then settling just about zero for the second half of the forecast. In the context of the evidence that I've presented in this speech so far, the pathway to goods price inflation arriving at the historical average is plausible when we look at the CPI microdata, and it's possible looking at the DMP expected data. For services, however, neither the DMP expected prices nor the CPI microdata would appear to be on track to follow such a quick pathway to target consistent inflation. There's also the evidence of the benchmark historical trend of 0 for core goods and 3.5% for services that has in the past been associated with that 2% headline inflation. I said these are the dotted lines. The return to historical trend is an implicit assumption in the specification of this BVAR. But as I noted in my September speech, the question of a return to historical trend that is not time varying remains a question. And in fact, in my September speech, I arrived at a different conclusion. So this takes me to my final gap, which actually doesn't have a final slide, so don't worry about that. Taken together, the previous discussions of goods and services CPI data, the CPI microdata, and my econometric models, all of these use a benchmark for normality of a return to the historical relationships to be 2% target consistent, core goods have to be 0, inflation in services needs to be about 3.5%. Now, is it reasonable to use these historical gaps? Could they have changed? In thinking about risks to achieving the 2% target in the medium term, an important question is whether near flat or falling goods prices are probable in the medium term. Quite possibly not, as Brexit frictions continue to play a role and global supply chains are being reconfigured. The 0% historical average for core goods was importantly influenced by trade liberalization in the first 2 decades of this century. More immediately, upside risk to shipping and insurance costs associated with the Red Sea turmoil may affect near-term inflation outcomes and be magnified through that firm level pricing setting behavior, which would augment persistence. And I worry that such an upside inflation shock, coming on the heels of the recent high inflation environment, would be more swiftly incorporated into the firm's costs and pricing, exacerbating upside momentum, which would be slow to dissipate when the shock subsides. If core good prices are not likely to trend around zero, then services prices will have to decelerate further than 3.5% in order to achieve the 3% target, the 2% target. And of course, services inflation has been sticky, well above that. To conclude, my vote last week was based on prospects for rising real incomes, continued labor market tightness, positive forward-looking indicators of activity. Plus, financial markets eased too much already, with numerous bank rate cuts embodied in the market curve and mortgage competition reducing those rates. Headline inflation is close to, but not at, our target, and it's my job to ensure that 2% inflation is achieved sustainably. My assessment is that the dynamics of headline inflation is not a good guide to prospects in the medium term. Digging deeper, my assessment of medium-term inflation prospects has been importantly informed by these various gaps that have been assessed between goods and services inflation. These gaps call into question whether or not services and goods will return to and be sustained at the patterns that are consistent with the 2% target. I'm also concerned about upward bias by firms when they set their prices, and how that might interact with upside risks to inflation from energy shocks. My decision at this meeting wasn't an easy one, but considering the gaps and the risks, I judged that an increase in bank rate of 25 basis points was necessary to keep inflation decelerating in a durable way towards the 2% target and stay there. Thank you.
Thank you. Yes, well, that was a very methodical presentation, Kathy, and I somehow feel we were in a court of law here. If I can take an American expression, you seem to be like the Perry Mason prosecuting these two people in the dock. One is services and one is goods. And I really like the very granular way you outlined all this. I've just got one question before we throw it over to the audience. And in a way, it's a fairly obvious question. And do you have a microphone which you've tucked away in that little shelf there?
It disappeared. I put it back in the chair.
Yeah. So the question is, you're looking at these differences between the services side and the goods side. Can you dive a little bit more deeply into the reasons for this, and also the sectors? When you're talking about services, are we talking about sectors which are more open to, or less open to international or domestic competition, for example? And can you tell us whether different sectors, the stickiness of inflation in the services sector is more prevalent in some sectors rather than others? I don't know whether you go into that level of firm granularity.
So on the goods side, I think when we think about goods price inflation, especially core goods, these are the ones that have more international exposure, and therefore are going to be driven by global forces to a much greater degree than in the services sector. Within services, we can make one major distinction when we look at services prices is between consumer-facing prices and business services prices. And business services actually are not the ones I'm worried about. Those are the ones that they have decelerated to a greater degree than consumer-facing services. So consumer-facing services, hotels, restaurants, travel, those are to some degree insurance and auto-related services. But the ones that I focus on the most, because they are a significant enough part of the basket, are the the entertainment services. And those have been remarkably robust. And there's corroborating information if we look at stock market, equity market, stock market returns. When we look at stock market returns for these types of entertainment, consumer-facing categories, those returns actually have been quite robust. Some people say it's only tourists who are engaged here, but I think there are a lot of other people who are enjoying entertainment in restaurants as well.
So we can blame it on the Ridley Scott Napoleon film, perhaps, some of this. Now, there's one or two gentlemen in the audience as well, and we'll come to others, but I see the microphone in the hand of Marco Springer.
Thank you very much for the presentation. Two quick questions, if I may. First one, you focus on inflation decreasing more than expected, boosting real disposable income, which could push higher the medium-term inflation. There are other two effects that people discuss. One is you have lower inflation than expected, but then you have higher real rates than expected. And the other one is lower inflation decreases the risk of second-round effects. So it'd be interesting to know why you focus more on the first one. And the second, we have seen a big revision in unemployment rate this week. The OMFIF says that high uncertainties estimate. Still, now we are 3.9. The Bank of England's got, if I'm not wrong, something like 4.7 at the end of the year. That's a big gap between where we are and where your forecast is. So how the Bank of England will interpret this data? Thank you.
So on the first question, why do I focus on the inflation rates as opposed to real rates? First, inflation rates are my objective, right? And so I'm focused on this in this speech on understanding the prospect for inflation dynamics going forward based on what firms actually think that they are going to do and when they set their prices. And in particular, the focusing on the expectations, this asymmetric firm behavior when their prices are below the industry average, expected to be below the expected industry average, is a very important ingredient in thinking about inflation persistence. We can also see that in the DMP data, but this empirical research uses a fancier apparatus than just a chart. We put it into a chart to make it digestible, but it's a fancier econometrics. In previous speeches I have talked about real rates and have looked at various different measures of real rates, but for this one, it's the inflation. This is the clear factor that I'm focusing on, the dynamics of it. On your second question on the unemployment rate, these are the provisional new temporary data, and how they will be embodied into our assessment. They did arrive not in time to be incorporated into the current forecast that was just released. We will have to evaluate in the next forecast how this changes the potential demand as well as supply side of the economy. As you know, in the report here in February, there is a section called, it's an in focus section that was looking at the supply side of the economy and the evolution of the labor force participation, the population in the country, including immigration. These are factors that will get incorporated into the supply side assessment going forward, because there were a variety of data releases that were not available to us when we did the supply side stock take.
Also, I noticed that you did speak about Brexit. You did mention that.
I did.
Didn't you?
I did.
So I'm sure there'll be one or two things there. Now, we've got several hands up. So Giuseppe, I see next, and then two in the front row. But first, Giuseppe, please.
Good evening. Yeah. Okay. Giuseppe Marafino, NMR. Thanks for your comment, very interesting. I found an interesting chart in your presentation, the chart showing the asymmetric behavior, firms' asymmetric behaviors in terms of price setting, which create structural upward pressure on inflation, which in my opinion really suggests that there will be some problem in terms of market structure, so lack of competitions in that particular sectors. So I was wondering how your monetary policy based on policy rates could address this structural issue. Otherwise, structural upward pressure on price in the sector means that you need to have a bias towards a tightening of monetary policy.
Also, if I could just add to that, you didn't say very much about the transmission mechanism, and people always say this monetary policy acts with this 18-month lag. Could you maybe bring that into it as well? You know, shouldn't we be seeing some action there rather than this softening of financial conditions that you were talking about? Shouldn't we be seeing some effects already?
So, you know, with regard to the question about shouldn't monetary policy do something about the degree of competition in various sectors, obviously monetary policy has very little role, if any, to play in terms of competition policy. We have to be aware and address the potential consequences of the market structure, and by virtue of my commenting on this research and pointing it out, and I'm making a point about the relevance of market structure, product market structure and competition in being a relevant consideration and backdrop for the monetary policy decision-making process. Now, with regard to monetary transmission, in the last, it was either last speech or the one before that, I very explicitly called into question the standard view that monetary policy worked with an 18 to 24-month lag. There are a number of different ways I could go into that discussion, but the one direct particular piece of research that is relevant for the question is that we can show, and there's a Bank Underground post on this, we can show using the DMP data that the announcement of monetary policy affects firms' expected prices. So in other words, the firms, if monetary policy announcement is to tighten, firms' expected prices come down. So whether that is because firms think there will be slowdown in demand or not, that's not the point. They choose to have a lower expected price incorporated into their own pricing strategy. So there can be an immediate effect of monetary policy on expected inflation. And through that avenue, expected inflation is relevant for actual price setting today, it is relevant for wage negotiations today, it is relevant for real interest rates today. So that channel of monetary policy immediately affecting expected prices is an important transmission channel, which is much faster than sort of a traditional demand, traditional story where you have to use the demand channel as the principal means for disciplining pricing behavior of firms.
Good to see you're rewriting the textbooks in here. Now we've got two down here, so first of all, Lou, and then yourself, Mary.
Thanks very much. I can't wait to actually read the paper. On this asymmetry, a couple different things I'll just sort of throw out there as potential implications. One of which you just talked about is the judging the effectiveness of monetary policy. I do wonder the scale of that effect. That does seem to me to be relevant, so that would be interesting to know. It also seems to me that that asymmetry could be the foundation for essentially asymmetric Phillips curve kind of reactions in that there are all sorts of cases. So for example, there was a whole literature around the missing deflation following the GFC. There was obviously some work that was done that time that linked that to credit availability. I suspect you haven't done that here, but it would be interesting to know sort of what that looks like. That's one way to come to it. My question is really about, when you think about this difference between goods inflation and services inflation, one of the things that seemed to be missing was level effects. So as I think about where we are right now, if I look at the relative price of goods relative to, say, some average measure pre-COVID, we saw this very strong spike up. They've come back down, but basically what we've seen is the inflation rate has come back to trend, but there's still a substantial gap. And it seems to me a very important issue in terms of near-term forecasting is, do you think those relative prices are going back to their pre-COVID trend or not? And that says something about what you should expect for goods prices in that interim period, which is obviously relevant for how much services, where services prices need to be consistent. So it does seem to me there's something, I'm not quite sure how it fits into a framework, which is this residual shock we've had to relative prices. How's that going to be resolved? How does that fit into that? Thanks.
Okay, let me see if I can remember all of the points. So one point with the first point is the sort of the magnitude of the pricing asymmetry. And then with reference to the GFC, I think those two go together, especially when you, if you look at these CPI microdata, you can see, I noted, and you only saw part of the time series there, there weren't any declines. No, there's great stickiness downward in services, tremendous stickiness downward in services prices, and so some of the missing disinflation is because services prices don't fall. How important the asymmetry is across an economy, I think that goes back to the previous question on how much competition there is in the economy. The less the competition, the more likely it is that you're going to pay attention to your industry leaders, meaning price leaders. And so the more competition there is, the less leadership, price leadership you would get. And the more sort of actual competition in prices, sort of in a traditional sort of way we think about competition. So yes, there's an interaction between the upside bias and market structure. And that's relevant for, again, because it's relevant for the inflation processes, it's relevant for central banks. On the question about levels versus deltas, the levels versus rates of change, I've spoken a lot about the challenge of getting the inflation rate on a year-over-year basis back down to the target consistent rates for goods and services. Even if those come down to target consistent rates of change, and so I showed some of the 3-month higher frequency presentation. That is getting down to the inflation rate, but there is no requirement that you get down to price levels that are the relative price levels don't have to get down to the same relative price level. The extent to which those price levels come back to relative prices as they existed in the past is a structural feature that is part of the end discussion that I had about whether or not time-varying inflation, whether you have time-varying inflation in the end, or you go back to trend-consistent, constant inflation at 2%. Now you mentioned Phillips curves in there, One of my speeches, I went into depth on how these various factors, especially forward-looking versus backward-looking price setting, which is not exactly the same as the asymmetric one, but it does have some similar features, how that type of analysis of price expectations, or the setting of expectations in prices, can be thought of as a shift in the Phillips curve. A lot of people talk about the shape of the Phillips curve, curved Phillips curves. I think everybody thinks they're curved, so that shouldn't be a problem. But there is differences in views on whether or not the Phillips curve has shifted or drifted. To the extent that any of these asymmetries or backward versus forward-looking price setting, either of those is associated with a shift in the Phillips curve, which makes achieving the 2% objective more challenging. It worsens the trade-off between achieving inflation at 2 at a particular employment or profit margin objective. Makes it more difficult. There's an appendix in the speech that goes into all the details.
Good. Well, you're setting yourself up for another speech, I think. So we've got Miriam down here, and then there's 4 or 5 others. Well, please.
Hi, Mary
from the Times. I just want to dig in a little bit about what's driving firms, as you say, sort of margin rebuilding. Is this about compensating for rising wage bills? Is it an energy story? And given that you mentioned that actually it's the sort of entertainment sector which hasn't particularly seen a hit in their margins, is it actually a rebuilding story, or is it something closer to the sellers' inflation, price gouging narrative, given that a lot of these sectors have not necessarily suffered? And just to be a bit more explicit, are you saying that given that market structure isn't necessarily something that monetary policy can affect, are you making a more explicit recommendation that this is something that consumer bodies and consumer welfare authorities in the UK should look at, a bit like how the FTC thinks about its mandate in the US?
So when I said entertainment sectors, I mean that includes restaurants and hotels, and many of them are not in a position of having made up their margins, right? By and large, our data and our agent reports in particular, we work a lot with the agents. Their view is that most of these firms have yet to return to the margins that they had prior to COVID. So it is a making up margins, not excessive margins. So I think that's a very important factor to consider. Just as rightfully workers want to catch up in their wage negotiations for the inflation in the past, so that their real wages return to what they were before, if not a little bit better. Firms too have margin objectives. Some of them are disciplined by the stock market, some of them are disciplined by banks in the lending process, but firms too have catch-up, and that's what they're trying to do. And to some extent, the decrease in the deceleration and decrease in energy prices have helped. But of course, for some firms, they had negotiated, and again, our agents tell us, they give us a lot of detail on this for individual firms in their regions, that many firms signed contracts when energy prices were a lot higher than they are now. So those firms are kind of in a difficult bind because energy prices are falling kind of around them, but not in their own cost structure. So those firms are just trying to make do with the structure that they have, cost structure that they have. It's not my job to recommend how to approach the problem or the challenge of changing market structure. Our research can identify that as an issue and having implications, but there are multiple approaches that are not within our remit or our capability to affect market structure.
Sounded like a semi-recommendation, anyway, to the extent that you can. Just We've got several others, but since you were mentioning hospitality and so on, again, a question which came out of what you said earlier on in terms of, I did want to mention the word Brexit again before Trevor Greetham does when he asks this question in a moment. But that sector was one where traditionally before Britain left the European Union, there were a lot of people from other EU countries who were working in it. And also, of course, it was affected by COVID as well. Has the tightness in that sector, the fact that people are actually reaping the benefits of greater profit margins and so on, does that surprise you? And has that been partly because of the fact that they have been managing to hire new labour, perhaps at higher costs than before? And so that's actually gone into their, the fact that they've got a greater propensity to raise inflation. Has that got something to do with the Brexit effect?
So first, I want to emphasize again, there's the margin rebuild is not the same thing as excessive margins. And firms are in a position of rebuilding margins. In some cases, they're in a position of rebuilding margins because demand continues to be relatively strong for what it is that they're offering in a consumer-facing servicing sector. It is certainly the case. I mean, we do analyze the economy and real incomes from the perspective of deciles, low-income versus low-income households, high-income households. We spend a lot of time looking at those deciles and evaluating how different monetary policies and how different costs and how different wages, how different prices affect those household income across different deciles. So we try to take a pretty active look at where the capacity for firms interacting with consumers, how that happens. So there are people who are relatively well off and continue to be relatively well off. And they are in a position of engaging with these consumer-facing services sectors. 60% of consumption is done by the top 40% of the income distribution. So we have to look at the macroeconomy as it's presented to us. The digging down, some of which I've presented here, is a way of looking at the dynamics as they evolve so that we can better understand how monetary policy is affecting the different groups.
Good. So I'm going to take questions in pairs now because we've got about 20 minutes left. We did start a bit later. So first of all, please, can you put your question and then we'll have that linked up with Trevor here. And then I saw you, Mark, as well, and others. So we'll do them in pairs. It means an even greater feat of memory for you. Please.
Thank you. Jack Meaner from Barclays. Hopefully two really quick ones.
Please do make them very quick.
But so the first being, I really like the chart on the kind of fraction of prices that change month to month. Obviously, the missing part of that puzzle is how much they're changing when they change. So I wondered if you've done any digging into that. And the second one is about a gap that you didn't really mention, which was the output gap. And on the forecast last week, obviously, even with the kind of additional financial conditions loosening, there was a negative output gap opening up through this year and next year in the bank's forecast. I just wondered, is it the right way to interpret what you're saying, that essentially there needs to be a bigger negative output gap opening up than the bank currently
Trevor, could you put yours then directly afterwards, and we'll try to bundle the answers together.
Yeah, okay. So Trevor Greetham at Royal London Asset Management. I mean, my question is more about the UK-specific factors that you mentioned in terms of price setting. So since the beginning of 2020, the CPI level is up about 20%. The whole retail prices index, including mortgage rates, is up about 30%. And a 2% inflation target, they should have risen about 8%. So there's a significant overshoot, we know that. How much of that, roughly 12%, cumulative overshoot would you attribute to UK-specific factors that you highlighted, like Brexit, like labour market tightness or competition? And does that sort of, the significance or otherwise of how big a proportion of that overshoot is UK-specific, help inform the premium that interest rates in this country will need going forwards?
So three good questions.
So let me on the microdata. What is interesting is that the the share, and this is the share of price increases and price decreases map almost directly into the behavior of the aggregate CPI. So even though you would think that the magnitudes of those price changes should be a very important ingredient in driving the aggregate, the relationship between the micro and the macro, in fact, that is not true. We are continuing to do work to look at magnitudes, but we pulled back a little bit because, you know, part of this objective is to understand, go from micro to macro, and if what you've done by looking at shares is gets you to macro dynamics, then that reduces a little bit the incentive to kind of go that next step and to look at magnitude of the price changes. But you know, you can talk to Leonard, you know, and Natalie. On the output gap. So the output gap is a very aggregate concept. It is one that is prone to significant mismeasurement. As you could tell from my assessment of the prospects for demand going forward, I would have a different, I'm in a slightly upper part of the fan for GDP. I spend a lot of time in the upper part of the fan. I've said that before, and I'm going to say it again, the upper part of the fan. So it's an upper part of the fan for me. And of course, there's also the assessment on the supply side. And the assessment on the supply side, I think, is importantly is derived from exit out of the sample of low performing and low productivity firms. And that is a challenge that could create a less of a supply side growth than is currently in the stock take. So if you combine a little bit more demand and a little bit less supply, you get a very different output gap. So your question was, I'm not sure I understood the second half of your question, which was something about mortgage rates.
No, not mortgage rates. Sorry.
Take another mic.
Take a stab at it again. I'm sorry. There was the sort of how.
Very quick.
So people can understand.
Right.
Listening
Yeah.
around the world.
So,
What I was trying to get at was you've identified UK-specific factors. I know in the past you've shared doppelganger analysis,
Yes.
for example, which seems to suggest there's quite a big wedge associated with Brexit and other factors. That's historic, but how much do you think those UK-specific factors are likely to result in higher interest rates than a doppelganger economy that didn't have those factors?
So the other, you know, yes, I did the doppelganger paper and subsequent research has identified the drop in number of firms associated with both importing and exporting, smaller firms finding it more challenging, and that change in the population of firms in the trade arena is something that has continued. It wasn't sort of a one-time drop and then everything stabilized. So that is a continuing part of the landscape. And I can't, you know, frankly, I cannot say that interest rates, I cannot identify a Brexit explicit share of, you know, monetary policy. That's, you know, the interest rates, this amount is due to Brexit. You really can't do that. There are a lot of things that have happened. You know, there was Brexit is a shock, COVID's a shock, energy shock, and so an awful lot of pieces have been juggled around in the economy, and so it may never be possible to kind of cleanly separate the one from the other.
This is like a perfect murder, isn't it? It's very difficult to decipher all that. So we've got Mark here, and then the lady from the Dow Jones as well. Please, Mark, and then can you give the
most sensitive for the...
Yeah, so my name's Mark Boland, I'm from Red Intelligence here in London. So my question is also on mortgages, which are still viewed as this main instrument of monetary policy. And so even if the Bank of England will be cutting rates in the next few years, which seems to be a consensus expectation, you have a quite large number of households that will be transferring from very low rates to significantly higher rates during this period. And at the same time, you have a high number of households, well, primarily older households, which have already paid off their mortgages, but probably have a high number of interest-yielding assets in their ISAs, and pension plans actually have a positive wealth effect from this. And how do you tackle that kind of intergenerational and also inter-income impact of monetary policy to action? I think it was a Financial Times correspondent who mentioned that a good way to feel young was to go to a fine dining restaurant because the average age is very high. And of course, the fine dining is probably quite a small part of the overall restaurant sector, but it's still, how does that, have you looked, what are the people that actually are eating out a lot and how is driving the restaurant inflation? So just a bit about that. Thank you very much.
And let's have your, please, madam.
My name is Miriam from Dow Jones. My question is, markets currently price in around 3 to 4 rate cuts from the Bank of England. Do you see possibility of no rate cuts this year? And then another question.
No rate cuts, say, this year?
Yes, and then will rate cuts in the US, and if they start this year, that influence Bank of England decision? Okay,
so so you started off with talking about mortgages and ended up talking about fine dining. So we have a very detailed assessment of the channel of bank rate through to mortgage rates, and then on to implications for cash flow, because we do have the UK data on mortgages is the envy of the world, actually, in terms of the details. So we have a very, very good handle on how prospects for mortgage rates would affect cash flow. Now, of course, the relationship between bank rate and mortgage rate is a function of the competitive landscape in mortgage lending. And that is something we don't control, right? That's something that is a function of the, again, the competitive landscape. And so we do track that very, very carefully. Now there, of course, is another channel of transmission, which you've mentioned, which is on interest-bearing assets, and we can follow that too. And so we have the identity, we have the micro data, but ultimately we do have to aggregate it up to the macroeconomic outcomes. The micro data, as I hope I've identified through the discussion here, is the micro data helps us understand the macroeconomic dynamics, but ultimately it is macroeconomic dynamics that is something that we have to address, and we only have the instrument, the single instrument of bank rate. So we track it, we understand it, we do look at, say, marginal propensities to consume for different income groups and for different age groups. So we do have a little bit of information on that through the NMG survey, which is one of our surveys. And so we can get a handle on whether or not, if certain people get more interest on their pensions, what it might mean for consumption. But again, we have to aggregate all that up to get to our aggregate indicators of activity, employment, and inflation. We don't individually survey people who are at fine dining restaurants. Our agents do, but we don't.
They go there, presumably.
Yeah.
They have to observe.
On the second question about rate cuts here and abroad, I've presented here a variety of data that I am looking at very carefully in order to assess what my appropriate vote will be in the future. I've given you a sort of breadcrumbs of what kinds of things I look at. So if you want to go look at them yourself, you can go ahead. It's all public. So I can't say whether there will be rate cuts this year. The market thinks so, but you know, I'm not going to make that judgment. I have to see what the evolution of the economy is. With regard to possible implications of rate cuts abroad, last year I gave a speech on basically looking at spillovers from monetary policy actions, principally in the United States. Could be done from the ECB as well, but this particular exercise was to look at implications for the bank's reaction function of monetary policy changes abroad. There are spillover effects. They take place through trade. For example, easing monetary policy has an effect on global markets, global aggregate demand, and that affects the UK through the trade channel. Easing monetary policy abroad also has implications for the UK through capital markets, and that would be also relevant. Both the demand channel from abroad and the capital markets channel from abroad are important inputs to the behavior of the UK economy. And so in that regard, you know, if there are spillovers, they've been well documented, and yes, they affect monetary policy. But I can't make a judgment about whether and when the Federal Reserve might alter their policy stance. When they do, it will have an effect. And at that point, I will make the appropriate judgment for my vote, as well as, you know, my colleagues will make an appropriate judgment based on their assessment of the situation.
Thank you. We've got two questions from the front. I've got a feeling that I've left, yes, please you, sir. You've been very patient. You were one of the first to put up your hand, so you get the right to put this question as a self-standing question before we then go to the
Catherine, it's a simple question, actually. You seem to be on the hawkish side of the committee.
There's a little bit of an understatement.
Yeah. What data do you expect to change your mind through the process? What flag you are looking to change your mind, and vice versa? Your colleagues that they are on the other side of the opinion, what kind of data they look to say, Catherine's right, we have to go hawkish?
It's after they read the speech, surely.
Yeah, I don't think so.
So I think I said at the end explicitly the answer to your question. I am looking, I've spent a lot of time looking at goods versus services. I've identified that goods are about on track to return to something that is close to target consistent behavior. I spent a lot of time identifying behavior in the services sector in terms of price setting, where it was much less clear that services were on track to return to target consistent behavior within the forecast horizon. And so the word that matters the most to me is to see a durable deceleration in price setting in the services sector. Durable meaning it's not good enough to have it only a couple of data points. Durable means more than a few.
Like say 3 months?
Well, so the microdata, the very detailed microdata, had 6 months of deceleration in the share of prices increasing. But that share is still too high. And that is in the microdata, which has not yet been fully reflected in the macro data, the CPI services. Plus, we get back to the point that Lewis was saying is it takes a long time to get from where we are now to 3.5%. 3.5% being that historic average. And if goods doesn't get to and stay at 0, which is its historical average, then services will have to fall further. And so that is why I focus on this gap between the behavior of services and goods, because that gap has persisted in the data for an extended period of time, for decades. There's some variation, of course, it's not like it's straight line, but the gap has persisted. And so that gap and how it evolves, and all these different ways of trying to get at understanding that evolution, is the key ingredient for me. And right now the problem is the evolution and the narrowing of the gap. When we look at services, that evolution is, and the narrowing in the gap is very slow. Very slow.
And the other question, which was about when all the other people on the committee who persist in thinking that they are right, when are they going to admit that they're wrong?
That's for them to make a judgment.
Good. We've got 2 questions at the end. Yes, well, if there's probably is still time. Does it apply particularly to that question?
So direct follow-up.
Oh, okay. Well, please give that lady the microphone just for a very quick one. And then we'll just follow up with the 2 down the end, and that'll be the end.
So, Isabel Mateos from BlackRock. I think the question that was put to you was, what would it take to change your mind? And I was wondering if you could clarify if what you answered meant change your mind to holding or change your mind to cutting. And assuming it was the former, what would it take for you to move to a cut vote? Thank you.
A very granular question. Thank you.
Durable reduction in services inflation will get me from one step, step 1 to step 2, and then it's unclear to me right now what would be the constellation that would take me to the next step. When I did the turning point speech, which was really almost exactly a year ago, I ended up by saying that it was not good monetary policy to boogie dance, meaning change up, change down in response to incoming data. So I don't want to do that.
Thank you for telling us what that word means. So Ellie and then Alistair.
That was actually, I was going to touch on that point around the dangers of loosening to only have to then hike a little bit later on, and actually that we were, not that long ago, there was a speech around the tabletop mountain, and so actually the length of that. But I actually wanted to touch on a couple of times we've talked around the labour market. David mentioned Brexit, but so I want to kind of wrap that all into the package of demographics and how you see the changing demographic shifts in the UK playing into the potentially a different environment, as you're saying, around the goods and services. So actually we can't use the same underlying principles that we've done previously because we are facing a huge demographic shift. So Ellie.
Vast topic, and then Alistair, another vast topic, I'm sure, from
yes, sorry, also large, but a short question. So the MPR sees quite a drag on consumer behaviours from housing ahead, and the high frequency data says housing's going back up already. Could you comment, please?
So I'll take the last one. I think it is a risk in the forecast, and part of my, I'm in the upper part of the fan chart on consumer demand is because a key channel of monetary policy, in theory, is that higher mortgage rates, higher interest rates tend to depress house prices. That is not something that we have seen in the UK. And so that does imply something about the strength of the monetary policy transmission mechanism through that traditional complex. The demographic question, I'm going to wrap that all up into saying that our time varying trends, which is something that we already observe in our BVAR apparatus that I talked about last time. Those are important ways of getting some totally astructural view of how these demographic things might play out. And as a researcher, that's where I would go to try to first do a completely unconditional structural unconditional BVAR, find those variation in time varying trends, and then put that into a regression with demographics in it and see what you get out.
Good. Well, that brings us to an end. Something I've always admired about you, Kathy, is the way that you answered these questions in an incredibly meticulous fashion, and you've done that today. And there's hardly been the proverbial piece of tobacco paper between your thoughts and your words, and that really is something that we all appreciate very much. And I think taking this data-driven micro and macro, it's been a great tonic for us all, as well as I'm sure other people on the Monetary Policy Committee will be following all this all avidly. My final question to you is a more personal one. It could be something you can't tell us about, but it seems to me you're just getting into your stride. I think there's quite a chance you'll break the Andrew sentence record on this, which I refer to before your term does come up at the end in September. Are you going to carry on? It's been very enjoyable having you here on these shores, and maybe you want to stay on for another 3 years. Perhaps it's not in your gift to decide, but do you know whether you're going to have another 3-year term?
You're right, that's not my decision.
Well, anyway, it's been great having you here, and long may you continue, and long may you break the Andrews sentence record. I'm sure you'll get the NBC equivalent of some kind of cricketing cup when that happens. So thank you very much indeed for your thoughts and for the way you answered the questions. Thank you.